Yeah, welcome to today's class. In today's class, we're going to look at bookkeeping concepts. And what is concepts? Concepts simply mean the principles, how things are done, or generally accepted method of doing things in a particular profession. That is the concepts, general view, general adopted principle. So today we're going to look at bookkeeping concepts. What is bookkeeping? Bookkeeping simply means the process of recording and maintaining the books of accounts of a company or an institution. And the books account of the company simply include the cash book, sales day book, purchase journal, ledgers, return inward and return outward, and the journals. These are the 7 books of account. In other words, we can call it the 7 books of Moses. For accountants, we call it the 7 books of accounts. We have the cash book, sales day book, purchase day book, journals, return inward, return outward, and ledgers. So we're not going to go to the 7 items we mentioned now, but we're looking at the concept of bookkeeping. Now, what are the concepts of bookkeeping? We have 2. 1, we have single entry method of bookkeeping, and the second one is the double entry method of bookkeeping. These are the 2 concepts of bookkeeping and accounting we are stating in this class. So let us explain one. What is double entry concept? Double entry concept states that in every transaction, 2 parties are involved: the giver and the receiver. The giver can be called the supplier or the creditor, while the receiver can be called the debtor or the buyer or the customer. And that principle of double entry states that when a supplier or seller or creditor supplies an item to a client, to a customer, the customer will now receive the goods. When the customer signs and receives the goods through the invoice, he will now debit the customer for receiving and credit the seller or the supplier for giving. When the customer now pays for the goods, he now receives. If the goods is, let's say, 100,000 naira. Now, if the customer now pays, let's say, pays 70,000, then the customer will be credited for paying, while the supplier will now be debited for receiving, for the value of goods is supplied. Now the balance in that account is simply 30,000 naira. That 30,000 naira is still remaining in the books of the buyer as a debit balance, while in the books of the supplier is still remaining in the books of the supplier as a credit balance that is still expecting from his customer. Now, the next thing we will do after preparing this is to transfer the record to the trial balance. In the trial balance, you have to debit the debtor and have to credit with that 30,000 naira in the trial balance. That is the balance. Then when you go to the record of the supplier or the creditor, you now credit the creditor or the supplier or the seller with that amount of 30,000 naira that is still remaining unreceived from the customer that is supplied goods. So now we have ended up in trial balance. So from that place, every account can take place. Thank you. If you have any question, please forward it to us. This is New Idea Consults online school, where we deliver accounting lectures. My name is Christopher Ejem. Thank you and God bless.